Welcome to The Explainer. Today we're talking about something really interesting that's happening in the markets. The Federal Reserve finally cut interest rates, which should be great news, right? But instead of a huge rally, the market got, well, kind of nervous. So let's break down what's really going on and where the opportunities might be hiding.
Okay, so what's the deal here? On one hand, we got the exact news the market has been begging for. But on the other hand, the reaction was super choppy and uncertain. It just doesn't seem to add up. So what's really happening behind the scenes?
All right, first things first, let's get really clear on what the Fed actually said on September 17th. Because, the devil's in the details, and those details are key to understanding why the market reacted the way it did.
So, not only did we get that 25 basis point cut that everyone expected, but the Fed basically telegraphed that more cuts are coming. This wasn't a one-off thing. It was a signal that, hey, we're planning to keep easing things up. And this is exactly the kind of long-term good news the market is supposed to love.
But instead of taking off like a rocket, what did we see? A little pop at first, sure, but then a lot of selling. This is a textbook, classic case of buy the rumor, sell the news. Basically, the market had already anticipated the rate cut for weeks, maybe even months. So when the news actually dropped, all the traders who'd already bought in just said, "Thank you very much," and took their profits.
Now here's where it gets really interesting. This sell the news reaction didn't just happen in a vacuum. The Fed's announcement landed right at the beginning of what is, historically, a really tough time of year for the stock market.
And check this out. This slide shows a massive split right down the middle of the month. If you look at 75 years of data, the first half of September is actually pretty good. But the second half, oof. From September 17th onward, the historical annualized return just plummets into the red, an eye-watering negative 25%. And if you thought that was bad, just wait. Let's zoom in even closer. The single week from September 20th to the 26th is, on average, the second worst performing week of the entire year. We're talking about a staggering annualized loss of over 43%. It's just historically brutal.
So when you put it all together, you've got the sell the news effect, these incredibly strong historical headwinds, plus some market turbulence from options expiring. Well, the market's nervous reaction suddenly starts to make a whole lot of sense. The long-term story looks good, but the next couple of weeks have some serious historical baggage.
Okay, so with all that short-term gloom, where's the opportunity? Well, believe it or not, this turbulence might be setting the stage for a big fourth quarter. Despite the market chop, a few specific sectors actually did really well on the day of the Fed announcement. And it just so happens they also have strong seasonal tailwinds going into the end of the year.
The source points us toward three key groups: consumer finance, airlines, and banks. These are all sensitive to interest rates, and they're not just random winners. They led the pack on Fed Day and have powerful historical trends suggesting they could be the ones to watch for a Q4 rally.
Let's take consumer finance. This group tends to build momentum like a snowball rolling downhill as we head toward the holidays. The chance that it'll beat the S&P 500 starts at 58% in October, climbs to 67% in November, and hits a whopping 75% chance by December. It just gets stronger and stronger.
And banks? Well, their story is even more dramatic. They pretty much underperformed the market for the first 9 months of the year. But then, it's like a switch flips. In the fourth quarter, they historically outperformed the S&P 500 by an average of over 5%. And we are right on the doorstep of that strong season.
So, we've got the sectors, but let's bring this down to a single company to really see what this looks like in action. While the source material we're looking at covers a bunch of potential stocks, it highlights one in particular as a great case study for this whole setup.
And that stock is VIP Shop Holdings, ticker VIPS. The reason it's getting called out is because it just made a huge technical move. It closed at a price it hasn't seen in years. This wasn't just a random one-day pop. It was a major breakout from a long period of being stuck.
And the really key thing here is that it's not just one signal pointing up, it's everything flashing green at once. It broke through a major price ceiling, the money flow indicator is soaring, it's outperforming the market, and it's all happening on strong volume. It's the whole package, suggesting this move could really have some legs.
All right, let's pull all of this together. We've talked about the Fed, the weird market reaction, the historical headwinds, and the potential bright spots. So, what's the bottom line here? What does this all mean for you as you look at the market for the rest of the year?
The big takeaway is really a two-part game plan. Part 1, respect the risk. The history of late September is what it is, so it pays to be cautious for now.
But part 2 is to prepare for the opportunity. The long-term setup for the fourth quarter looks really strong, so the strategy is to use any market weakness in the coming weeks as a chance to get positioned in those areas that are ready to run.
And that really leaves us with the big question, doesn't it? We've got this clear conflict: short-term historical risks versus a really positive long-term picture. The stage is set for a very interesting final quarter. The only question left is, what's your next move?